Hello, everyone, and welcome at this ceremony. It's a great pleasure to be here and to open and introduce this lecture. This is part of the celebration for our 150-year anniversary. Ca' Foscari, as the video says, was established in 1868 as the first school of advanced studies in economics in Italy. And since then, so it's a long history, disciplines of our legacy. Since then, Ca' Foscari has gained itself an international renowned reputation for economics, management, foreign languages, the humanities, and more recently in the sciences. In fact, with the recent investment in cutting-edge research facilities in science and technology, together with its history, Ca' Foscari is nowadays widely acknowledged and regularly ranked as one of the best universities in Italy and in Europe. As I said, this year we're celebrating our 150th anniversary since the foundation, and we've used the celebrations as an occasion to steer our development towards the future. So not just a celebration of the past, but also a way to shape our future and to give direction to our forward-looking vision of this university as a center of outstanding research and education, and as a home for young, talented students and researchers. So with that vision, forward-looking vision, as part of the anniversary celebration, we have started this Nobel Lecture series, Nobel School, as we have called it, with which we intend to bring to Ca' Foscari outstanding scientists and scholars, have them share their experience with us, give lectures, as today's lectures, be part of our academic life, and be in touch with the students and share their experience, motivate us all as scholars and scientists, and you guys as students for which vision we work for, to give you the best of the future and to make your dreams come true. This program has sponsors, which I would like to thank. One is Fondazione Venezia, who has put a special donation for sustaining the school, and the Bowers for supporting the day of most of the guests. Today we have one special guest, so please join me in welcoming Professor Robert Merton, recipient of Nobel Prize in Economic Studies in 1997 for his work on stock options. Professor Merton will be with us in the coming days, sharing his experience with different talks at different venues. Tomorrow he will be in San Giobbe with the master students of our programs. The day after will be a keynote speech at Credit 2018, an international venue organized by the Department of Economics and Monica Bilio in particular. Today he will give a lecture on solving global challenges using financial science, past and future. It's a lecture on finance, but on finance and how finance impacts our life outside the technical field. So it's an inspiring view from an inspiring speaker. And I would really like to thank Professor Merton for having accepted our invitation, and for sharing a bit of his experience with us these days. Welcome at Ca' Foscari, Professor Merton, and please join me in welcoming him. So, with his lecture, we also award Professor Merton with our honorary fellowship award, and the ceremony starts with the laudatio by Professor Pellisson.
So good afternoon to everybody. It is an honor to be here today to celebrate the Professor Honorary Fellowship of Professor Robert Merton at the Ca' Foscari University of Venice. Professor Robert Merton got his bachelor degree in engineering and applied science at Columbia University, a master in applied mathematics at the California Institute of Technology, and a PhD in economics and at MIT. And it is now professor of finance at MIT Sloan. He was professor also at Harvard, then he came back to MIT, and I think that the place where he has to be is MIT. He's one of the founder of the modern finance, contributed to the development of both asset pricing and corporate finance literature. And this is a very peculiar aspect, because if you're looking to what me or other people, the most recent academics in finance, either we specialize in corporate finance or in asset pricing. Well, he was able to do both very well. He's also able to do both very well. In the 70s, with Fisher Black and Myron Scholes, he developed the Black-Scholes-Merton formula for option pricing, largely used even now. And this is the key characteristics of all his work. It's not something that is just remaining on the piece of paper, but people can really use what he's inventing. He gets the Nobel Prize in 1997 with Myron Scholes, and he's actively producing research even now. As an example, Monica Biglio and myself and Andrew Lowe and Mila Getmansky wrote a paper with him. And an aspect that I like more of him is his ability to always surprise me by pointing aspects that I never thought about. We spend hours, Monica can really confirm this, in discussing details on our paper and new ideas. We have a lot of other ideas that we are planning to develop. And in all the cases, it was always orthogonal to what usually me and Monica are thinking about these different topics. In all his courses, in all his careers, he was always thinking out of the box and attempted to make the finance work simpler and useful. This is one of the main characteristics of him, and I think that we need to learn on how to be really good academics and also applied academics in making things simpler and useful. But let me read what one of his former, I think his first PhD student wrote to me about him, Professor Marty Subramanian from NYU Stern, that spent some time writing to me about you, Bob. So Bob Merton is the dream advisor for any PhD student in financial economics. By a stroke of good fortune, I found myself in his class 48 years ago, when he was a freshly minted assistant professor. I realized soon that unlike my other teacher, he had a very different way of thinking, a rigorous, disciplined way of laying out a complex argument. I let a bit of this seep into my bones, and to this day, benefit from this way of thinking almost 5 decades later, even as my own research interests have mandated through various parts of the paradigm of financial economics. I'm eternally grateful for his guidance when, as a wet behind the ears graduate student, I wrote my first paper. He took me under his wing and made the kernel of an idea into a great paper. This was my first published paper, and I believe his first joint work with anyone other than Paul Samuelson, something I'm still proud of. Bob is the academic son of Samuelson, the greatest economist of the second half of the 20th centuries, and I bask in this glory as Bob's own academic younger brother, since I'm too old to be his son. Marty Subramanian is 71 now. But to conclude, it is with a great pleasure that I introduce to you Professor Robert Merton. It is an honor for Ca' Foscari to award him this prestigious honorary fellowship and give me the opportunity to tell him, thank you, Bob, for coming after 7 years that Monica and I are trying to invite you here. Welcome to Ca' Foscari in Venice, the place of the Serenissima Republic that also contributed a lot to the development of finance.
Just the motivation for the award of the Honorary Fellowship, which is awarded to Professor Merton in consideration of his fundamental contributions to the understanding and development of financial markets, and in recognition of the Nobel Prize in Economic Sciences he was awarded in 1997. Professor Merton.
Gaudiamus igitur jubileum sumus, Gaudiamus igitur jubileum sumus, post jucundam juventutem, post modestam senectutem, nos habilitumus, nos habilitumus.
Well, thank you very much. It's a great honor to be here, to have been invited here, and to join this very, very special community, intellectual, cultural, and social community that I've been inducted to. So I'm now one of you. And I do have to thank my introducer, but if I were truly rational man, with a capital R and a capital M, I would simply come up, thank you all, thank her for her kind remarks, and sit down. Because of course, there's no possible way I could live up to the expectations that she's created. But that would hardly be appropriate on the occasion, so I'll try my hand at trying not to disappoint you too much. Okay? My topic for today, and I'm going to take my watch off. You know, we all know academics like to talk, and as those who know me, I'm known as a talker, and we would be here for a very long time. So I'm going to be disciplined, or try to be disciplined. And so let's get started. The topic is looking at global challenges and using financial science, past and present. This connects all the points that were made. You know, finance is a science. I'll talk about that in a minute. Finance is special, I think, even within the branch, as a branch of economics, because it seems that finance science, both structural theoretical work and empirical work, at the most advanced levels, finds its way into the mainstream of practice like no other part of economics. And I'm going to talk a little bit about how that happened. I'll talk a little about the past because we need history to understand, particularly in these times. But I'm going to focus mostly on looking to the future. So we'll get started. First, you know, the role of innovation and finance science on growth and development of the economy. The first thing I'm going to point out is the financial system is essential, a well-functioning one, to growth and economic development. It's not a sideshow. Some of you who've studied economics, particularly farther in the past, learned there was the real economy and the financial economy. We had dichotomy. Well, I'm here to report to you that except in some out-of-dated macro textbooks, that dichotomy doesn't exist in the real world. The two are inexorably linked to one another. As a shorthand as to why I say that, growth, which my former professor, colleague at MIT, Robert Solow, received the Nobel Prize for in the 1987, he showed that it was not frugality of saving or population growth that was the principal driver of growth itself, but instead it was technological progress, and that was quite a different inspiration. Now, how does that connect to finance? Well, around MIT, as I'm sure here, there are wonderful ideas being generated in the lab, new technology all the time, just fabulous. But if those ideas generated in the lab don't find their way into the mainstream of the economy, that technology will never have an impact on economic growth. One of the roles of finance, a very important one, the means by which the funding, the risk-taking, and all the elements that are needed to take great ideas, bring them into the economy, and allow them to be dispersed throughout the economy to impact society. Another Nobel laureate, Douglas North, also wrote on the importance of this institution for economic growth and development. Now, if you, this is the 10th anniversary of what we call in the United States and the West, the Great Financial Crisis. I think my recollection is your crisis here was a little later. But forgive me for being provincial. I'm only just joined you. I will get into your culture more as I spend more time with you. But looking at it from the West, this is the 10th anniversary. In fact, we just had the passage of Lehman, which is often taken to be the spark that drove the economy. And if you look at the reaction to that crisis, it was a sense that first, innovation, and financial innovation is how we improve or change the financial system, okay? That innovation was in some way a principal source of the problem rather than being a solution. And the reaction was cut everything back, tie it down, go back to a easier or simpler time, if that ever existed. What I wanted to show you today is, while I won't debate whether that's accurate or the right policy to have followed, it isn't always that way. And so those of you who've been more involved, either as students or faculty over the last 10 years, I want to give you a peek at the past to show you some of the things of which finance had. That done, I then want to move rapidly to the future, because I think that's, that's what we're really interested in. The past is useful, but principally to think about the future. So I want to start by talking about when finance became a science. Now, here particularly, I could argue that finance really as a discipline dates back, well, some will say to the 11th century, but I would mark it as late 15th century here, with the development not only of double entry bookkeeping, but that was done earlier. By the way, as we all know, success has many parents. Failure is always, of course, an orphan. But I won't debate the original origins, but what I think is quite clear is the book that was published by Pescioli here, I believe in 1494 in Venice, marked, sort of the beginning of real accounting, the setting of the better, because it wrote down the principles and laid the foundations in a way that could be conveyed to others. Instead of a kind of a learned apprenticeship, there was a set of rules and principles from which one could use as benchmarks for standards, but also convey the ideas just as they're done in the classrooms today. But finance has become a different or a separate field from accounting, and that's the finance I'm talking about here. And in that regard, I would say prior to the 1950s, finance was not a science. It was not a science because it really was based largely on just accounting identities, nothing wrong for accounting, but no additions there, no separate principles. There were no data at all. And how can you have a science if you don't have data to confirm and confront hypotheses? And that all changed in the 50s. And the first I have on my list, and others could disagree, was Harry Markowitz. Those of you who study finance, of course, know the portfolio theory, in 1952. There are three ways to manage risk. Don't worry, I'm not going to get into technical details. But there are only three ways: diversification, hedging, and insurance. And Markowitz brought a systematic approach to understanding, measuring, and optimizing diversification. The role of securities, Kenneth Arrow's work, taught us what it is that markets can do and what they can't. And then we had Modiani and Miller. Modiani, the great, I always like to say, American-Italian economist. Of course, here, he's well known in this land as the great Italian economist who did visit us in America. Then we had a very important point, the development of the first comprehensive database at Chicago, Chris, and that began the real being a science, because we now, for the first time, had exhaustive, very large, and quite impressive set of real data to confront all the stories. Now the stories are how things worked, but do they really work that way? And I won't take the time this afternoon to get into what happened on the first day they examined that data. But it had a profound impact from the beginning. The efficient markets hypothesis, if you know what that is, Farmer and Samuelson, the capital asset pricing model, at least some of you have had to slug through, which told us that not everything has the same expected return because not everything has the same risk. And then we had various testing go on. So by the time we got to the end of the 60s, finance clearly had identified itself as a science. It had principles, foundations, hypotheses, and serious data that were in a systematic way used to confront those hypotheses. And I would mention too, there have been 8 Nobel Prizes in economics for work done in finance. So I'm not going to try to convince you anymore it's a science. Oh, I should also tell you, since Nobel Week is coming up again, the Nobel Prizes in physics, chemistry, and economics are decided by the same institution, the Swedish Royal Academy of Sciences. The others are done in different ways, but those three are done the same, by the same process, by the same everything, the same body votes on it. So I just want to tell you, those who are in finance, don't listen to anybody who starts saying, oh, well, finance and economics really isn't a science, okay? But we'll move on. So I would mark it there. By the way, it's a very young science. Harry Markowitz, who I would not call the father of modern finance, just the beginning. Harry Markowitz is not only still alive, he's still working. So you know it's a young science when the person at the beginning is still there and working. So let me move on into what I wanted to take you forward from there to the 1970s. Don't worry, I'm not going to take you line by line all the way up to today. But the 1970s was a very interesting period for this purpose, because I don't want to be into comparing crises. But I'll just very quickly remind those who maybe hadn't studied it or too young to remember it, that's probably most of you, okay, what hit at that time. We had the fall of Bretton Woods. For 30-odd years, currencies had all been fixed. You didn't have to think about exchange rates, they were fixed. Suddenly they exploded and became floating, something we hadn't experienced for a generation. We had the first oil crisis, where oil went from $2.50 a barrel to 13 or 14, and we didn't know we had to number them, but we had at least 2 big ones during the decade. Third, hard to believe where we are today economically, we had double-digit inflation in the United States. We hadn't seen that since our Civil War in the 19th century, over 100 years. There was nobody alive who had any experience with it, let alone what to do about it. And similarly, we had double-digit interest rates. There was no mortgage money for housing because we had regulations that only let banks pay up to 5%. It doesn't take a rocket scientist to figure out which will you take, 5% from a bank or 10% full faith and credit from the government with a tax break. See why there was no money. So housing completely crushed. But then we had a phenomenon, by the way, that did not happen, thank goodness, in this previous crisis. With those high rates of inflation, we had 9% unemployment. High unemployment and high inflation wasn't supposed to happen. It was called stagflation. Very hard to deal with. Think of the ECB and other central banks and government policies had you simultaneously with the unemployment been facing 10% inflation. Very hard. Let's hope stagflation does come back, because I don't think we still know how to deal with it. Stock market fell. So the point of this little list, and I'll move on, a lot of bad stuff happened all at once, shocks to the system. But then I want to show you what the response was. By the way, if you can't read these slides, they're not meant for you to look at while I'm speaking. They're meant for you if you hear anything interesting. You can get a copy afterwards, and then you can remind yourself what it was that interesting you heard. So let me just, I'm not going to go through all of them, but the reaction, very different from this past crisis, was an explosion of financial innovation. We created the first option market. Well, options are nothing more than financial insurance to insure financial values of all kinds. We created currency markets to hedge the risks futures markets to hedge the risks of currency, stocks, interest rates. We had money market funds, index funds came in there. There's so many things we could talk about. International diversification in investments, which we take as normal today, actually just began then with institutions. Before that, there was none. And we had changed the structure of all the financial markets because we got rid of the cartels on commissions, and that institutionalized the financial system. We created a national mortgage market in the United States. And never since then, where we got the funding for our mortgages from around the world, not just from local banks, but you access capital from around the world. And since the creation of that market, there has never been a time in the United States where there was not mortgage money. The rates go up, the rates go down, credit's a little tighter or not, always mortgage money. As I pointed out, that was not the way the world was prior to that. And I point these out to you because these are not only innovations that were a response to the crisis, these are a response to the crisis which then paid social dividend and have been paying social dividends for the decades since. They were permanent improvements to society. We had financial globalization. Well, so I hope if you don't get all the details of it, you get the overview. Namely, a lot of innovation went on, innovations that we take for granted today, because although these happened in the United States, they migrated afterward everywhere in the world. And they were adopted in the other parts of the world, not under duress, but by choice. And I think that's the best vote of confidence, that these innovations were not only important, but that they were valuable, enough to copy them. Okay? But the thing I want to point out in respect to finance science, and I had the good fortune to live through all of this, in fact, to be a part of it. So I'm actually, you're looking at a relic who isn't, I'm telling you firsthand, I was there, we did it. We took the finance science and addressed these problems of creating these innovations, and you couldn't have done these innovations without the science. There was no way to do it by, intuitively or so forth. There was only one way to do it, and that was with the complex models, computers, theories, empirical work developed in the science. And it was then that finance as a science, I mean it as a, at the highest level of research, both empirical, became joined to the practicing community in a major central way. And that joining has continued to today. So that's one story. I thought those in finance, I thought you might want to know a little bit about the history of the field you're going into or are in. Okay, now, that's a history. I'm not going to talk about the present. You're living in the present. So now I want to talk about science and innovation's impact for dealing with challenges in the future. And there's so much going on, I could fill the room here, but I've tried to choose a couple of examples. Before I move on, I will have to mention one thing, because banks, once again in Italy, banks are a discussion, right? Maybe they always are. But in my country, they are too. One innovation that was developed, actually in the early 80s, called the interest rate swap. It's a financial contract, not very complicated to understand, but it allowed banks, by using this contract, to deal with the mismatch that some of its clients wanted floating short-term rates. They want to get their deposits whenever they can, and others who are borrowers in double-digit interest rate environments for real estate, et cetera, wanted fixed rates so that they didn't bear that risk. And as a result of the bank meeting both those client needs, they had enormous risk in the banks because their funding was floating cost and their revenues were fixed. And when rates went up, they all went insolvent. And that had nothing to do with credit risk. It was the largest risk in banks throughout the time. Overnight, one contract, the interest rate swap, has eliminated that forever. That is not a risk that any bank has to take, and they can eliminate that risk not by changing what their clients do. They still do the right thing for their customers. I'm talking about good banks, okay? I mean, look, everything has its good and bad features. They're good players. Let's all agree we want to get rid of all the fools and knaves in any profession. So, but I'm saying that good banks got rid of the biggest risk they have. And that's just profound in the sense of what that's done for efficiencies in the area. Okay, so let's move to the two examples. And I tried to choose two that were relevant, that work everywhere in the world, of importance, and maybe tickle your interest a little because you've heard about them or thought about them. The first one you wouldn't have heard of because we just created or invented it, and it's getting somewhat of attention. And this is an example of an innovation that, unlike what I was describing before, doesn't involve complex models. It's really simple. I mean, simple. And it seems almost trivial change, but by making those changes, you're solving some very big challenges everywhere in the world, including here in Italy and in Europe. Okay? And so let me describe that first. And then the second one, particularly given what your rector here, his specialty, I thought in his honor I should at least use the example from that, which is the finance and technology, fintech. The impact of all the big data, all the things that we're seeing in technology, we carry around with us, being brought in and transforming the financial system. And that's a very hot area with lots of promise, lots of opportunity, but very many challenges as well. So I thought I'd talk about that in my last minutes. Okay, so let's get started. I'll go through the first one. And I'm going to define a bond for you. It's going to have a name. It's called a selfie, right? You all have taken selfies. And selfie stands for Standard of Living Indexed Forward Starting Income Security. That's a mouthful. That's why we call them selfies, okay? Now, what is it? It's a bond. It's a bond that should be issued by government versus other entities, or at least that's the best place probably to have it issued. But it's going to have a little bit different characteristics than the bonds you're used to. The bonds that you normally would buy, okay, if they have some maturity to them, they pay a periodic interest coupon payment every 6 months or something, and they continue to do that till some future date, 5, 10, 15, 25 years later, and when they finish, they give you your money back. They have a big balloon payment. That's the typical bond. What we're talking about here as a bond is we change the payment schedule to a very different pattern, a pattern where when you buy a selfie, you get no payments for a certain number of years, none. Then at that later date, when I'll explain to what it is, it starts paying you. After a time, I'll give you examples, it pays the same amount every month, quarter, 6 months, whatever you choose, but it pays the same amount for a certain number of years, and then it ends. But when it ends, there is no payment at the end. So if you were picturing the time flow of payments, it's at 0 for a period of time, and then it continues at a certain level, and then just stops. It is a bond, but the payments are different. Those of you who are looking for something familiar with that, think of your pension payments. Now, you're too young to be retiring, but you can imagine. When you have a pension system, what do? You put your money in. Do you get any payments? No. When do you start getting payments? When you reach a date, your retirement. And then what do you get? You get payments, right? And for how long? As long as you need them. But then it stops. There's no balloon payment at the end. So what this is, it's a bond that moves the payments to none and then a flat level. And because of this structure, this turns out to become a very useful solution for people and institutions who are trying to fund retirement, which is an issue around the world. And the way you can think of it is, let's say, I think I can guess. There's someone in the room who's 45 or close to it. That person, let's say, is planning to retire when they're 65, 20 years from now, 2038. We would say to that person, you want to save for retirement? Buy a 2038 selfie. Selfies come in different shapes, dates. They all look the same, but they start and end at different dates. A 2038 selfie doesn't pay anything for the next 20 years, and in 2038 it starts paying. If it was a 2042, it wouldn't pay anything until then. If it was a 2025, it wouldn't pay anything to that. So do you understand? You can buy any date. They're all on the shelf, but the only thing you need to know is the date that you're planning to retire. And I just tell you, buy it. And there's nothing else you have to do after that. Now, how does it work? Well, the 45-year-old goes out and buys a selfie. The example here, they can come in very small sizes or very big ones, but small sizes. It pays $5 or €5 a year for the 20 years after it starts. So if it's 2038, it starts paying there, it stops in 2058. So, okay, so that's the structure. So the 45-year-old buys this. What does he or she have to do after that in terms of buying? They get no income from it till they retire, at least till 2038. So they don't have to make any decisions. They don't get a bond coupon and say, oh, how do I invest that coupon? What do I do with it? They have nothing to invest, so they have nothing to do with this bond. When they get to 2038, what's happened? It starts paying $5 a year, every year, more or less for the rest of your life. It's not annuity, but it's like that. So there's no reason for you to change it. That's just like a pension. That's exactly the payments you would want when you retire. So what did I trying to show you? You just do one purchase when you buy it. And really, if you retire when you're planning to, I mean, you can change the bonds. It can be sold like anything else in the market and replaced with another one if you change your mind. But if you just buy them, you make one purchase. You never have to buy anything again. You don't have to make any decisions again. You don't have to deal with problems because it's been matched to them. Now, there's one other feature here which is very important, I think, to making it successful. I made it equal payments, but it's not. It's equal payments, but it's indexed. And what I mean by indexed is it isn't nominal payments. It's index-adjusted payments. You're all aware, I think, of inflation index bonds that pay you inflation plus the rate so you are protected against inflation. Well, we don't do it with that way. We do it with something else. We index it to per capita consumption, the amount for people aggregate consumption. Now, why do we do that? We do that because that consumption, unlike inflation indexing, will protect not only against inflation, but what else? Standard of living changes. You know, if you buy a bond that, you know, you're planning to retire in 20 years, even if it's protected for inflation, do you think you're all going to be happy with the standard of living today, 20 years from now? Think back to what your standard of living was, what kind of vehicles you had, what kind of electronic equipment you had, and so forth, 20 years ago. It's very different. The beauty of using per capita consumption, you don't even have to disaggregate between inflation and standard of living. No reason to. We just give you both. So this person that buys the selfie bond knows that if there's inflation, their payments will be adjusted for that, so they don't have to worry about it. Second, they know that if the standard of living goes up over 20 years and then maybe the next 20 years, which is a long time, so it could make a big difference, you're covered for that too. So the whole idea here is to make it simple, direct, easy to understand, and do what people actually need, rather than get people to try to learn and adjust the instruments that are traded there for their needs. So the idea of the selfie is this works for individuals. It works in countries where a good part of the population, I won't comment on Italy, I've always learned it's a big mistake to come to a country. I've been here before, but to come to a country and try to tell people in that country what it's like in their country, not a good model. But there are many countries in the world where people are not a part of the pension, any kind of pension. They're not part of the official sector, but they still need to deal with retirement, that part of the life cycle when they're no longer working but are living. Selfies will do that for them because they don't need a pension plan. They can just buy selfies. And again, I remind you, all you have to know what to buy is what year you're planning to retire. You don't have to know what an interest rate is. You certainly don't have to know what compound interest is. And you don't have to know any of those other things like how to convert a pocket of wealth into a stream of income. Very complicated stuff. So if you think about it, and I don't want to belabor this too long because I'm looking at the clock here, okay? But think about this. Simple, easy to describe solution. It's just like a bond, just a little different payments. So therefore, it's easy for regulators, for governments, and so forth to understand what's being created here. That's good. May not get you a lot of publications because it's too simple, but it's really good in terms of getting things implemented. But looking at it from the point of view of the retiree, how many times have you heard we're going to have to educate people as they become more responsible for their own retirement? And how are we going to educate them to know what to do? Even very highly educated, normally people don't know what to do, including my 150 IQ, 3 PhD nanotechnologies colleagues at MIT. When they look at their retirement, they don't have a clue either what to do. So the idea was to design it so there was a minimum amount of stress and hassle, and it fit what they would need. Okay? And the only information they need is when they think they'll retire, nothing else. And how do they know where they're doing? You know, you've been buying selfies for 10 years, 15 years. How are you doing? It's very easy. If you owned 1,000 selfie bonds, 2038, how much are you going to get in retirement? 1,000 times 5, you'll get 5,000. If you have 10,000, you're going to get 50,000, okay? So you know exactly, just by the number of bonds you own, what you're going to get in retirement. There's no discussion. Except what you get in retirement is adjusted both for inflation and standard of living, which means the number of bonds and the amount you see right now are a good comparable to what you will be getting in real and in standard of living adjusted terms 20, 30 years from now. So you don't have to go through all these forecasting. Well, I know that sounds like a lot of money today, but when it's 30 years from now, it won't buy anything. I'm not going to go through all of this, but what I want you to see is the idea is make it really simple but good, meaning it does the job well. Who else would use this? At the other end of the totem pole, every pension plan out there, every insurance company that writes annuities for retirement will buy these bonds too. They'll buy them to hedge the liabilities that they promised to pay. It's an ideal hedge because it matches the payments that they have promised to give to you, rather than a standard bond that they have to do all kinds of things. So this one simple innovation is able to deal with both the unofficial sector of people who don't have pensions. It's able to allow individuals to get saved for themselves, to add to their pension, and it allows people who have no pension a really low-cost, simple way to do it. By having government issue it, people aren't worried that maybe they won't get paid. That's important too. So that's why a government. Now, last point I want to make, that's on this. When you issue a bond like this, why aren't they being issued right now? And they are to some degree, but they're not being issued widely now. Why aren't they? Because no one will issue them, certainly in the private sector, unless they have an asset that has the same payment stream as the bond they're issuing, so they're not taking risk. In other words, if they write a bond indexed to something that they don't offset that risk with their assets they have, they're just taking a pure bet, and they won't do it. So you want to have assets that match the payments. What asset does this government, and virtually all governments except my own at the moment, have that matches paying people aggregate per capita consumption indexing? So in other words, if consumption, both nominal, consumption goes up, an asset that will give them more money to pay out. Have you heard of a VAT? VAT tax? What is that? That's a consumption tax. At least in principle, it's supposed to be taxing exactly the thing that you're paying out. So the governments hold an asset, a VAT tax, that matches what they promised to pay. No private sector entity has an asset like that. That's why the government is a natural issuer. It has the best hedge. It will be able to issue it in large size if there's a demand, and people can be comfortable that they have an asset that will offset that, so taxpayers don't end up with some fiasco of having to bail out the government for promises they've made that they don't have provision for. That's why you'd like to have government do it. But notice one other thing. Many governments, many countries around the world are very interested, and I wish mine was more in doing it. They talk about it, but my country we don't. They're very interested in investing in infrastructure. What's the nature of an infrastructure investment? Tunnels, airports, roads. You have a lot of payout while you're building, no revenue, and then the revenue comes much later, right? That's a common thing for any infrastructure, sometimes quite a bit later, because sometimes it takes a long time to build these infrastructures and get them up to where they're generating. Try going as a country to bond investors and saying, we want to build infrastructure that's not going to pay anything for 20 years or 15 years, but when it's done, then it'll pay all this stuff. So we want to borrow money for 15 years, pay you nothing, Mr. or Ms. bondholder, and then we'll pay you for the next 20 after that. If you were to try to go and issue that, maybe not in Italy, but even maybe in Italy, you'd find you'd have a tough time issuing that bond. And if you did issue it, they'd only let you do a little bit of it, and they would charge a very high interest rate premium because they're not getting paid for 20 years, anything. Okay? What's the issue here? What's the finance principle for those there? They're the wrong holders of these bonds. You're trying to get someone who doesn't like that pattern to buy it. Not surprisingly, they charge you a high price and they won't do much of it. I don't like castor oil. I don't drink much of it anyway. And if you pay me enough, I take some more. But who does like it? Everyone who's dealing with retirement. You individually and every pension and every insurance company. Their pattern they're looking for, they don't need payments. They don't have to pay the pensions for many years. You don't need to receive your pension for many years. You don't want it. What you do want is the payments later, and you want to get as much payment as you can each year. No balloon. So what we've done here is very simple. We've matched the needs of issuers with the needs of purchasers. We found two big sets, retirement and infrastructure, and matched them. That's a simple principle. But when you do that, you get magic. All right, I'm not going to beat this anymore, but what I would finally point on this example, one bond, and you saw it's pretty simple. I'm not saying, you can look at this later. It is really pretty simple. It's very close to things you already know. This one bond solves three policy problems in one. Funding retirement, including the unofficial sector. people who aren't covered. What else? Funding infrastructure, low cost, reliable, okay? Because once this money goes in, it doesn't come back out. It's not like borrowing from foreigners who then pull their loans. So you're left with half a tunnel or half an airport, okay? So we managed. What's the third one? If the country decides it has too much exposure, risk exposure, to consumption through its VAT tax, it's too concentrated in that source of revenue, it can do risk management by issuing more selfies and sharing the risk. Instead of the government taking the risk of the ups and downs, the marketplace will around the world. So 3 policies, 1 bond, simple to understand. That was the illustration. Not high complex mathematics, and it's 3 for 1. That's a very efficient innovation. So we've addressed some pretty big issues, infrastructure and retirement. Now, how much time do I have left? Somebody? Well, I promise, because remember, this is the rector's, you better deliver, at least in my community. The president of my university, I listen, make sure he's happy. Used to be a she, but it's now he. Okay, so now this is just a little innovation chart. The only reason for looking at this is a timeline from the 12th century. And you can see innovation happened much faster sooner we've got here. So everything is speeding up. You didn't need to be told that. So now let me talk about fintech, the combination of finance and financial services, all of them, and in bringing in the latest technology, big data, high degrees of computation, and so forth. And I'm sure if you've been on this planet, you've heard of it. Every central bank in the world is studying it and worrying about it. There are really big challenges. What do the innovators say from, let's say, my Silicon Valley? So I won't indict anybody here. Most of them technical. They say if you're going into financial services as a profession, not a good idea. And if you're in it, you should go back to school and find another profession. Because between the technology that we have and AI, there's not going to be any jobs for any of you. We don't need you. Technology and AI are going to replace everything and everyone. It's all going to do it for you. Now, I'm being a little unfair, but not very, because there's a lot of discussion of that. And all I wanted to finish with this afternoon is to say, like all big, strong stories, it has some truth to it, but a lot of it is fantasy. And I wanted to try to give you a little hint why. And I'll tell you where I think it will be. First of all, no question in my mind, fintech is going to have a big impact on financial systems everywhere, financial services. Those who are not being serviced well are probably going to be disproportionately benefited. That's the good news. There's going to be disruptions. The story is all the institutions you see out there, banks, insurance companies, they're all going to be so disrupted, they're going to be replaced with Google or somebody like that, Alibaba or somebody. And that's not so good, particularly if you're a shareholder or you work in the bank. And some of that's going to be true. In fact, where will it be? Who will benefit from this? There will be losers, but who will benefit from it? And my message, because I see I don't have much time, I want to point out to you, is there's an assumption, which they say explicitly. People trust technology. Because with your health or your financial services, the real ones, the one that matter to you, it's probably the second most. I don't care where you are in the world. You will not take those services if you don't trust them. If you don't trust your doctor, if you don't trust your hospital, if someone hands you a drug and you have no idea what's inside there, you're not going to take it. So trust is essential. Now, quickly, because of the time, I have to short-circuit this, so I'm going to use some technology myself. I'm going to use medicine for a moment, because you can all for sure relate to that, to explain what I mean that it's not trusted. I have here in my hand a Samsung Galaxy Note very fancy technology. I'm not a technologist, but this is very fancy stuff from a very well-known manufacturer. And if I click on it, there's a Google in there. And it says, OK Google. Everybody know OK Google? Well, you can ask it any question. It gets an answer most of the time. So before I came to the lecture, don't worry, this is a hypothetical. I had a really bad knee, really hurting me, bad. And maybe I have too many miles on it and it's going to need some work. But it's hurting me. So I take my phone, you can all do the same, and I say, OK, Google, what do I do about my bad knee? And in 14 seconds, it comes back and says, cut it off. Show of hands. If you got that answer, would you do it? Anyone? You're not sure? Oh, okay. I saw a tentative. Well, what did we just demonstrate? This is technology, well-known technology. But not one of you were willing to do what it told you to do. Well, I think that was pretty wise. I wouldn't either. But did you ever ask yourself why you wouldn't do it? Well, I'm not questioning you. I'm not suggesting you should have done it, okay? But why? Well, if you think about it, first and most importantly, this is opaque. It's not transparent. Not at all. Even if you're an electrical engineering graduate or professor at MIT, you don't actually know what's in here. You know in concept what may be in there, but you don't know what's actually in there. Very few people do, other than the people who make it, or the people that, use it. But what we do know is being used for all the advice is a model, because everything is a model. Gödel's theorem says you can never have a complete description of reality. So whether it's in your head or your computer or in this machine or an AI machine, it's incomplete. It's a model. And what is always true, therefore, no matter whether it's physics, chemistry, life sciences, or financial economics, models require assumptions, abstractions. What do you leave in and what do you leave out as a descriptor or a model of the complex world? The abstractions. That, in my view, is the art of science, whether it's physics, chemistry, or economics, or life sciences. It's what are the proper things to leave out so you get answers that work, and what are the things to be sure you have so that the answers you get from your model are close to the right ones for outcomes. That abstraction is there. You cannot get rid of that. So I don't know whose model is being used in what I was telling me that about my knee. If I don't know whose model, maybe they just went down to the store and got a book off the shelf on, or how to take care of these, done by, who knows what, with some crazy ideas. And they put it in the machine. That's where you're getting your advice from. So you don't know what model's being used. What else don't you know? The model uses data. Do you know what data is being used? Do you know, is it clean data, complete data? Is it dirty data? Those go to competency. What else you don't know? What was the motivation for the model that was put in and for the data that was used? Suppose it was a body parts company. I don't mean to be gross, but I get your attention that way. Maybe they're trying to generate a lot of supply. In other words, maybe they're not trustworthy in the sense that they have an interest different than yours. They're not giving you the best advice for you. They're giving you advice that helps them. So without trust, which is both trustworthy, but trustworthy is not good enough. My grown children, I would trust with my life to make decisions for me. Maybe I shouldn't, but I do. But I wouldn't let any of my grown children near me with a scalpel because they don't have the competency to do the surgery. So you need both trustworthy and competence to have trust. And technology, as I've just shown you, by itself doesn't create trust. Two things that can be a substitute for trust are transparency. If two things are completely clear, you can say it so that to the point where you say two things are identical, transparently so, then I'll just take the one that's cheapest. I don't need to trust anyone. What else could be true? Verification. It may not be transparent, but if I could verify. So in a payment system, you and your friends all try PayPal, and it works. So you do it enough times, and you verify it even though it's opaque. That works. In things like investment advice, things to do with your money for retirement and so forth, that can't be verified. I show that in the notes here, but we won't have time for it. It takes between 40 and 400 years of data to get a significant enough statistic to reject the hypothesis just on the basis of the return series and nothing else of whether someone's a superior manager or not. You're not going to wait 40 to 400 years. That's not verifiable. So when things are inherently opaque and can't be made transparent, therefore, and when they're not verifiable, the only choice you have is trust. And in light of the time, if you want to get you to trust me as your new bait is in this community, I'm going to wrap it up here by just simply saying that trust, the trust asset, and that's what it is. I'm not talking about doing the right thing. That's what we always want to do. It also turns out to be the most valuable way to run a business if you have value to add, certainly in finance. So there is no conflict in that sense. But trust is the other asset that's needed. You need trust to go with technology. You will trust me as your financial advisor if I use his technology, not because you know anything about his technology, but because you trust me. I then have to trust him, which means he's got to find a way to get me to trust him. But you as my client trust me, not the machine. You see the connection? So you have a joint product here of trust and technology. Now, for those microeconomists who like to think about industries, when you have two factors of production, given the output, how do they get shared? How much of the total goes to the two factors? If technology is a competitive market, I'm not saying it is, but if it is, then we know they'll earn competitive, on the whole, they'll earn competitive returns. If trust is a little hard to be a competitive market, then they can earn higher returns. So I'll leave to you as an assignment for your thesis, looking at what's going on in financial services, the important part, the parts that you can't do by transparency or by verification. And that's a good chunk of the most value-added parts of finance. Ask yourself, how much is going to go to the trust asset and how much to technology? And think of that as an assignment. When you get it, send it to me. Anyway, there's a lot more in the notes about this, and I'm probably going to be talking about this in greater detail later in my stay here. So I hope it's incomplete, at least has provided a little teaser, either to show up at the next one or send someone to find out about the rest of it. But if nothing else, when you go away, hear this. FinTech is going to have big impact. But FinTech is going to have a lot of trouble in very important areas unless it can acquire the trust asset. And it's not automatic. It doesn't come because you have technology. And that's going to make it interesting to understand how it evolves, including, and then I'm really quitting, everybody says, and this is my terminology from my hometown, okay, the pizza boxes are going to all take over the world and all the banks, insurance companies are going to go away. That's the extreme. Think about this. If technology is available to everyone, which it is, you can buy it, I mean, it's not free, but if it's available to everyone, and if I'm a big institution, it's fully regulated, like a bank, and I've been around a long time, and you recognize it, if I offer the same technological benefits. The pizza box does, because I bought the technology. If it's the same price, which one are you going to pick? My bet is you'll pick the one that has the name, and I won't tout anyone, but of a well-known bank that you know is regulated versus a company that you really don't know where it came from, who it is, and you know it's not regulated. What does that tell you by continuity? It means the bank can charge a bit more than the pizza box, and people will be happy to pay it. They're paying for the trust, and they're paying for that if something goes wrong, you've got somebody to go after and hold accountable. And because they're regulated, the role of regulation is to help us to develop trust. So I just want you to think about that when you hear these stories. It may be a little more complicated to first order than you think. Thank you very much.
So thank you very much. We still have a little bit of time for questions. So if some of you would like to have the opportunity to ask some question. Closer.
Oh, I didn't ask for a lapel mic. I usually wear one because when I talk, I like to move around a lot, the way I do with my students, among other things, to make sure that they're not falling asleep. And, you know, so for the questions, we'll do it this way.
No, I'm very interested about this selfie, let's say, bond. But it seems that the only one that can issue it is a government, and you need, and clearly there is an issue on this regard that is sovereign risk.
The insurance?
No, the sovereign risk, because the issue.
Oh, sure. Okay, well, first of all, when I said government, I was thinking functionally. You know, if you don't trust the government's ability to pay, then it's not going to be good enough. But then you've got other issues, since the government has a right to tax and take anything you have anyway. So, I mean, you know, so I'm talking about government as an institution, not the government of Italy or the United States. Why do we have governments? We have governments in particular. I didn't talk about things like Bitcoin and all that stuff. We have governments, among other things, because they complete the financial system. What happens if everything was a cryptocurrency, just you picture that, and it's being done in, you know, somewhere, and we all wake up one morning and our screens are black, and we don't know why. So, and, you know, it doesn't do any good to say we put 25 backups in, because if the backups work, they won't be dark. But anyone tells you that with the 25 backups, it's impossible they can go black, I would get off that boat or ship. We built one of those in the United States in 1912. It couldn't sink, so we didn't bother to put lifeboats on it. What's the point? It's called the Titanic, okay? So I mentioned models. There's always a case. What do we do in every society? We have that when the payment system or anything that's outside the model, because we don't even know what's going on. It's not supposed to happen, but it does. It's unstructured. We have government as the solution, okay? Now, in some cases, it's big enough to figure it out and to calm things down. In some cases, it's not. I won't mention Italy, I'll mention Ireland. During the crisis, Ireland guaranteed all its banks. What happened? The credit rating of the banks, the CDS they're called, went way down. But what happened to Ireland's credit rating? Because people didn't believe that Ireland's government was big enough to support a euro obligations of its banks that had just guaranteed. That time means you need a bigger government, maybe IMF or maybe the EC, you know. So when I say government, I'm saying that's the functionality. I always treat government as the best you can do within your culture, okay? Because, you know, that's why credit ratings of companies in a country are not higher than their governments, because they know the government can always take the company, what the company has in their own country, okay? So I just want to be clear about that. But partly because of the reason I showed you that government has that ability. Often the private sector can't make a product because it has no hedging asset. That happened in the United States when we put inflation bonds in. Larry Summers, Treasury Secretary in 1997, pushed through having inflation-linked bonds. During all that inflation I showed you, we had no protection against inflation, period. It was not fun at 10% inflation rates, okay? But no private sector would ever take that risk without an asset. And real estate and commodities and stocks are not a hedge against that. Not good enough. So that's what I mean by government. Government's the best. Now, once government issues these bonds, as in the United States, as in other countries, gilts and so forth, real bonds, then the private sector will issue their own versions because they can always buy an asset, the government asset, to hedge the core risk, inflation, consumption changes. That's how it works. But it's also the case in this case that the government has a natural hedge asset. So those of you who are worried about the government, issuing things that's going to blow up the balance sheet and hit you with a lot of taxes, you should feel better about the fact that they have a natural hedge. And if you don't trust government, you could put in a rule that says if they issue these bonds, a certain amount of the VAT tax has to go to those bonds directly to pay it. I don't want to get into micromanagement. Oh, by the way, just quickly before we go to the next question, I don't know about you, when I hear a song for the first time that I like, if I don't like it, what do I care? First time I hear a song, she's singing, she's going, I don't know one word she's saying. Not one. But I like the song. So I put my machine on repeat, and what happens? It keeps playing the song, playing the song, playing this. After about 30 times, guess what? I know almost every word that she's saying. So for this discussion, if you don't get all the lyrics, I hope you get the flow of the melody. That for each of these questions, there really is an answer. It's not the same answer. But these things don't run out of answers. There really are answers to them. And you can drill down. So that's how I would put it to you. It's the best we can do. And perfection is only for the gods. I'll settle for better.
Still on the selfies, which are very attractive assets. Now I see the beauty of it because it's correlated to consumption, and so especially say for pension funds or long-term financing. But from the point of view of the individual, it seems to me that there is another decision to make, which is when to stop. Because if you are, say, worried about your survival, and you may be thinking, well, I'm going to live, I don't know, at age 120, I would like this to go very, very long. But if I think I'm going to die 2039, then I want all my payments in 2038, and that's it. So it seems to me that as an institution, this is easier, but as an individual, this decision is a little bit more complex than you said.
Very good. And you're 100% right, but now let me first respond by saying, one, we could do a version that actually does longevity risk, so it becomes a deferred annuity. We chose not to because that adds a lot of complexity. You'd have a lot of arguments in the government that the government doesn't have a natural hedge, and you'd never get it done. We do have institutions who are designed to take on longevity risk. They're called insurance companies. They don't have any special expertise with respect to interest rates or standard of living. So they can use selfies to hedge what they're no good at, or not particular, but they can take the risk that they've been designed to do, which is longevity risk. So that's, may you live to 120, absolutely buy an annuity, as long as it comes from a non-defaulting, that's going to pay what it promises. But I mean, we'll deal with that, okay? So that's one. The second one is, this particular instrument can be sold. if you know you have some congenital disease or, you just know you're not going to survive, then of course you wouldn't buy an annuity or something that's going to pay well past life. But you better be pretty sure of it, no disrespect. But if you're sure of it, and in that case, you do something different. We can't design something simple that can be universally used around the world that is tailored to every individual's need. So you would do something different. So everybody but those people who know they have congenital diseases and things that they're not going to live. Most people, 20s, 30s, 40s, even 50s, really don't know what shape they're going to be in for this question. And so this covers most of those people. It's no different than when you put your money in a pension fund or pension plan and it doesn't pay you until you retire. Now they try to make special provisions, but you can see you have that same problem. So I didn't solve your problem for that group, but neither is anybody else solving it. You see what I'm saying? And I know how to solve it if it was you telling me that about you and I'm your personal advisor. And maybe a fintech will be available to you that you trust, that when you put in there this, it says, don't buy selfies, here's the right thing for you. You see what I'm saying? What we're trying to do is solve a global problem. And believe me, the retirement issue is a global problem. I travel all over the world. US, we're aging, our baby boomers. China, with the one-child policy, is aging faster than US. Korea, faster than China. Taiwan, faster than Korea. It's like, and Japan. Okay. But it's also true here in Europe. And actually, in the Middle East, you wouldn't believe it. There's a very young population. They're actually worried too. Why? Because all those 25 and 30-year-olds, someday, they hope most of them will be 60-year-olds or 65s, and then you're going to have one heck of a bill, and they're worried about it too. So this is a very big global problem. Notice the selfie. I just want to point this out. I didn't say that's for Italy or for the US or for the West or even for a capitalist country, because it was designed on finance principles, not institutions. Just built from finance principles. Principles in finance work everywhere in the world, just like gravity at the surface of the earth here, Venice, or in Moscow, or Sao Paulo, or Beijing, is 9.8 meters per second. And just so, finance principles. That doesn't see culture doesn't matter in the final product, that's fine. But the selfie is an example that was derived on principles with no particular population, culture, or even market involved. Other than we say somebody issues bonds, and we assume government was the one that does, even in a socialist environment. So what I want you to see, this is another lesson that I can't resist. If you design things based on principles, you can build a global solution rather than a series of things for each country. So you have 21 different risk management groups for every country, and you have thousands of products. Sure, you have to make them a little different. Thais like green cars, Koreans like red cars, but you have a universal car and you paint it a different color. You don't really have to have different things. A selfie was designed to work anywhere in the world, and we'll see. I can report to you, this is really early going. I don't even think we have kind of a paper out of it. We did an op-ed, just to get interest, and then, The Economist on its own did it. Turkey's done it. Le Monde in France, Nikkei in Japan. An amazing number of countries have picked up on this and their governments. So I'm not saying selfie's the best. In fact, for those students and faculty members who want to innovate, this isn't the best. This is your floor. This is the minimum. I'm sure you can do better. But at least that kind of attention from things, those kinds of entities, they don't write about things that aren't interesting or they won't be in business. And governments don't usually call you up unless they find something interesting. So I'm not saying the selfie's the answer. I'm saying it's a floor and an answer, but I'm saying there's a lot of interest. And maybe this has moved it a little bit further. And I kind of wanted to show you something that almost exists. No one has issued one yet, but it's pretty easy to understand. There's a lot of attention. So this is a real-time description, and we'll see how it plays out.
Some students, fine. Okay, we have.
No, I think you, remember I warned you at the beginning. If you think I'm going to get tired of this, don't wait for that. You can get up and leave. I'll turn my back and you want to leave the room, I can understand it. It's much easier for me to be up here than you having to sit there, particularly, I mean, this is a little warm, but it's getting a little warmer, okay? So please, but go ahead, you had your question.
I want to ask you, what would you recommend to young people to study to be prepared for the future, for the new challenge that we have to discuss with?
Well, you know, when I heard I won the Nobel Prize, my mentor, colleague, co-author, Paul Samuelson, you've probably heard of him as an economist, said to me, you know, they're going to think you know the answers to everything in economics. But he said, that don't stop there. They ask you, think you know the answers to everything, so they'll ask you medical questions. So I'm going to answer your question in the context of finance, not all future things. And I would say what I've been alluding to. I think if you learn principles and functional-based thinking, functional means, you know, we mentioned solving the retirement problem. In every culture, in history and in the future and now, we're going to have to deal with how do we deal with the part of the life cycle we call retirement, which is the part of the life cycle where we're living, maybe even living, you know, fully, a lot of faculties, but we're not working and we'll never work again. See, that's a function because, you know, that's going to always be there and it's stable. It's been true in the past, it'll be true in the future. How we address that need is the institution. That is different everywhere in the world right now. If you look how it's done in some countries versus others, it's quite different. If you look at it through time, it's changing. It's not stable. So the first suggestion is learn things functionally. They're stable. They're your anchors. They're your axioms. Then you can understand institutional change instead of saying, whoop, we got a shock. We didn't know banks were going to be replaced by something else. Because now the institutions become part of your model. And you can think about, make predictions on, in fact, innovate by designing an institution that performs the function in 2018 better than the institutions that are doing it now. And if you want to forecast change, you say, what's the best way to do it? That's probably the way it's going to end up being done. You see what I'm saying? So the first thing is functions. The second one is learn principles. I think I've already illustrated this off these. Because principles don't change. Yeah, we add to our knowledge, but fundamentally very little changes. You know, we've moved beyond Newtonian mechanics, but it's still 9.8 meters per second in that part of the physics space where you can use classical mechanics. You see what I mean? So you add to it. It's very rare that a principle gets overturned, but if it does, you would deal with it. But if you have principles, then you can go anywhere in the world, and when you're designing things for efficiency, especially in the world of finances, whatever they tell you, you know, all about the populists and nationalism and cutting things off. The financial system is global, and that's not going to change. Okay, so in finance particularly, if you design on principles, that's a practical way to do things. Too costly, too complicated, too hard to manage operationally, to have all these different management groups, I mean risk management groups for every single country and thousands of products. It's not, whatever's right, that's not going to work. So I don't know if that helps, but if you focus on thinking functionally and on principles and you learn them, you'll have a long shelf life because now you can deal with change. Instead of saying, please don't change the institution from banks to Google until I retire. because I won't be able anything to do. If you're the way I described, you say, I welcome the change. Why? Because in my model, change is part of the model, just like the change in prices in the stock market is part of the model. Not because you can perfectly predict it, but you're prepared for it, you understand it, and you have an advantage because you do. Sorry to go on so long, but that's, that would be my suggestion.
Yeah, sure. Now, I wanted to, well, touch upon the fintech thing, because in the end, I mean, some of the issues about trust in technology are there for the models as well, because, I mean, technology is built out of models, but also finance is built out of models, right? And well, so there's opaque aspects in finance as well, in the theory, right? So, to what extent is there I mean, is the trust thing associated with technology alone, or is just with science and in medicine as well, right? I mean, epidemiology in the end has a lot to do with the trust in the people that conduct the evidence, right? So,
did everybody hear it? First, absolutely finance is a model. So is physics, chemistry, everything, right? Okay. So that's not what I was saying. What I'm saying is, I gave you an illustration of technology telling you something, you wouldn't do it. So somehow, no, maybe you would. Nobody in the room put their hand up, okay? I mean, okay, all right. So there's something about that it didn't work. I mean, it wasn't close to working. There wasn't one hand that said yes. So we seem to be in the wrong church, not the wrong pew. So what's missing? And if I had a longer time, I would tell you about my story about I have a doctor. She's an MD, PhD at the Brigham in Boston. I can walk to 2 of the top hospitals, 10 hospitals in the United States from where I live, and I got you both of them. I trust her. Let's not ask why I do. I do. And I trust that hospital. And if she, you know, if I had this bad knee and I went to her, she sent me to a specialist. The specialist said, Mr. Merton, you want to live after a year? You're going to lose your knee. I don't like that. Then I would go to the Mass General. That's the other one. And I would go to the specialist there. And if they tell me the same thing, at some point, I'm going to say, as terrible as it is, I'm going to do it because I want to be around in a year. Why? Because there was trust. Let's not ask how we did it, but it is. Technology by itself. They both, take 2 hospitals, take 2 doctors. They're both certified. The hospitals are certified, the doctors, they both have MRI machines. You have a checklist. What is the doctor going to do to you on the table? They each write down what they expect to do and check the box. They're all the same. Would you flip a coin on which doctor? I don't think so. You'd want somebody who's done 10,000 of them. You want somebody that you trust. So that's evidence that you don't have transparency. And that's what I'm trying to say. If you don't have transparency and you can't verify, I don't want to have to do surgery and then find out if it works. That isn't so good. So what I'm trying to force you to do is think about a decision that all of you made without a question. Why did you make that decision? That will lead you to the answer to your question. And absolutely by finance. And that's why I meant that, you know, that's why if you say, I've got X, Y, and Z Nobel laureates who are engaged in the models in finance, and they're finance laureates. If they're laureates in physics or chemistry, they may be putting their reputation on the line, but I wouldn't trust that they knew the models in finance. But if they know the models, and you had nobody, you're probably going to trust them, the models that they have put their, not only their name on, but they're really involved in. Can they be wrong? Absolutely. Are they less likely to be wrong than somebody hasn't? Probably not. That's where trust comes from. And again, I underscore, trust is not just trustworthy, it's competence. And we sometimes forget that. You know, the family as an institution in Asia, great idea, right? Because you have trustworthiness built socially into the system. So you don't need contracts. What's the problem? unless you're a pretty big family, you probably don't have the best knee surgeon or the best financial advisor in the family. Okay? So you have trustworthiness without the confidence. So we can go through every case, but what I'm trying to show you is the principle is, I didn't say how you get the trust. I said you need it. And what I'm saying is that technology by itself doesn't definitionally give trust. And I will tell you, and we had slides, and I can show you data of what's happened since we're taking a long time here, but I have slides here and so forth. What I can tell you is that you can see in the data how people have changed, and because they can no longer trust, okay? And the biggest decisions, the big value decisions, like people are talking about robo giving you financial advice. If you have a computer, remember, none of you wanted your knee cut off. Well, the sad part is if you just believe your computer because it comes over robo and it's very pretty and slick, and you do it, you may not know it, but it may be just as bad advice as to have your knee cut off, but you don't know it. And you won't know it because it isn't like, whoops, I put my money in a payment system and it didn't work. You won't know that you got bad financial advice typically, maybe for years, until it's too late. So that's what I'm trying to energize you to. And then, you know, I see you want to get up, so here you go.
So thank you very much. I think that now it's time to go, and if a lot of other people want to ask questions, we are having a drink and something over there, so we can just go there, and clearly you can continue to, in Ca' Foscari, where we can still continue to ask questions to him. But thank you very much for all your time. Thank you. You have still the diploma.